right? But unfortunately, our brains as human beings would like to convince ourselves that, we can do it in a shorter span of time. We can do it faster than someone else. And that's the cup of tea right now. Everybody wants to learn ICT stuff quicker, shorter to the point. And then I guarantee you, you're not going to get the results you're looking for. You're going to have to go right back through all this stuff I've told you to do. And that's where your consistency is going to be found and derived from. But if you're finding yourself being impulsive and trying to go back in to get a little bit more of the move that you didn't hold on for, that's showing you a character flaw. You're being impulsive. You're not being content with enough. Now, for those that have been following me for a long time, when you hear me or read many times in my tweets, I'll say, be content with enough. I'm reminding you that if you take something, that's better than a loss. And you engaged, you have experience now. And that impulsiveness that caused you to get out of the trade early because of either fear or anxiety, or just you just can't handle it, or you've had recently a string of bad trade ideas that didn't pan out. Your demo account just in drawdown, you want to build it back up a little bit, you want to just have a win. There's nothing wrong with that. There's nothing. It's actually one of the better things to do. Is as soon as you feel like you're feeling anxious after a losing streak, and you feel that tendency, I got to close it, I feel nervous, close it, and then watch the rest of it, and then log it like you took the whole trade, and then remind yourself that my idea panned out and I had to leave the position because I am growing in my trust. Now, notice that I said those words and not, I can't believe I bailed on this trade again. I'm so stupid. This is so dumb of me. I'm never going to get this. I'm so frustrated. You see the difference? And that's why I don't like to see people doing that in their tweets to me, because if they screw up, how you handle your screw up, your mistake, is going to set the path for you in your development and your consistency. Because if you're impulsive and then you get a bad result, something that was not what you were hoping for, and as an adverse effect of the decision making that you had, that's going to create or invite the opportunity for you to give yourself negative confirmations. You're going to give yourself reasons to solidify and immortalize that as a terrible experience. It was painful. It was embarrassing. You didn't do what you were supposed to do. Versus, okay, this is what I did. This is why I did it. And this was the aim of why I was doing it. And it's not a bad thing. Now, if you do something impulsively and you had a stop loss, and then you change the stop loss and start moving it around like a neophyte and opening it up more. You ever see me do that in my trade examples? No. I'm only taking the trade stop loss and narrowing the risk as the trade moves in my favor. My position is reducing the risk. I'm not opening myself up to more risk unless I'm pyramiding, and then I'm adjusting the stop relative to that new pyramid entry because of the new equity increase, or not equity increase, but the amount of leverage being used. But I'm actively managing that stop. But in this example, if you were to take a trade and you move the stop loss to a larger risk because you are afraid that you're going to get stopped out, that is something that you need to tell yourself. If you get stopped out with a larger stop loss being hit, you need to go into your journal and say, I made the mistake of not following the rules about opening my stop loss up. And this was a reminder of why the rules are to be followed. Something like that is not kicking you in the gut and driving the air out of your lungs and leaving you, demoralized. You're being responsible. You're holding yourself accountable in your journal. You're not sharing this online. You're not saying, hey, ICT, this is what I did. Blah, blah. You're not reporting to me. Those types of things go in your journal. You're winning things and you're losing things. Those things are recorded for your benefit. That book, that trading book that you're building with your journal, that's the best trading book you're ever going to read, because it's built on real experience and your unique perspective on the markets through your eyes, your personality brought into it, your unique experience. and it's unique to all of us. And that's the wonderful thing that I find so fascinating as a mentor, that I have so many diverse backgrounds and cultures and folks from all around the world that are doing it. And they all do it just a little bit different. And that makes it uniquely theirs. And I love that. So you got to know yourself. And it's a scary endeavor. And if you've been avoiding it, you need to just roll your sleeves up and say, okay, on a weekend, just evaluate what it is that you spend your time thinking about. Do you worry about making money, not making money? Are you going to get it? Are you obsessively thinking about, the worrisome idea of failing at this? Instead of doing that, you need to put yourself in a mindset where you're studying and looking at old things that you recorded in your journal. As soon as you feel like a negative wave is coming over top of you, you feel like something like doubt, concern that you're never going to get this, go back and look at old price moves that you have in your journal. That's the benefit of having a journal, and where you got it right. That's such an encouragement, because it's not like reading someone else's book or watching my video or watching my examples where I'm taking the trade. I know a lot of you like to live vicariously through me and my examples, but that only lasts for the video. When you have done something and you've either tape read, when you study price action without pushing a button, demo, or even a live account, and you're just studying price action or taking a demo, and you log that experience in your journal and you record it in your own words that this panned out exactly like I was expecting. It's so encouraging to see these types of things coming forward in my development. You want to be very positive in your journal. All your journal entries need to be positive. You want to be able to feel like you can't wait to go back and read them again. They're personal love letters to yourself. They're encouraging to yourself. No one's going to encourage you like you want them to do. Even me. I'm not there when you push a button. And when you do the funded account challenges, or you get a big withdrawal and you got money coming in your hands for real, I can like your post, I can retweet it, but that stops moments after that. And you might see other people come in and be a flurry of other people liking it and saying, hey, way to go, I'll be with you soon. That's encouraging, but that only lasts for so long. Unlike a trading journal that tracks your development, where you have real occurrences, where you yourself have done the work, you saw the setup coming and it panned out. When you have hundreds or more of those examples, and it doesn't take long to get them, but you have to do the work of logging it, recording it, studying it, and then seeing that you did it right that many times in the past. And then when you do it wrong, how infrequent that is, and how that becomes even less infrequent doing it wrong over time. That's the advantage of doing these things consistently and following a process. So having that mindset going in, that one trade idea is not your entire career, and it won't break you, and how you won't look at that as a way of inviting ruin to yourself. So knowing yourself, removing those weaknesses, or at least trying to keep them from influencing your trading decisions, that's important. Knowing the general market dynamics, that's also obviously a key factor in winning in trades. And what I mean by that, general market dynamics, market structure. I got a student that I literally just tossed out of my private group because he's literally teaching my private mentorship and teaching the 2022 model like it's his own. Whatever. But he's online saying that I've never really done work with market structure. I've taught more about market structure than anybody has. And see, it's not just simply knowing higher high, higher low. That's not it. You need to know the dynamics from the higher time frame down the lower time frame, and then the lower time frame back up to the higher time frame, and how all that fits together. Market structure is one component. That's it. But when you understand it, all it needs to be done is reduced down to what I showed you in the model on 2022. That's the only element of market structure that you need to focus on. Everything else that everybody makes these courses and videos about, okay, you got higher highs, higher lows, higher high, higher lows, and then you're going to wait for that shift. Okay, you can draw that out on a line chart and show all these perfect examples after the fact, but you're not showing examples of it right now, real time, and doing a trade. That's what I have an issue with. And that's why I don't like people trying to teach my stuff, because you can do it in hindsight and sound smart, but you can't do it going forward, which means you don't know what you're doing. So you can't teach that. That's how you discern who can teach. Hear that? Got a bullet point list. ICT's been knocking him off. He's been really focused. I got a bullet point list here. I got some shit talking at the end of this video, don't worry. The other part is seasonality. Seasonal tendencies, the effects of when the market is more likely to produce large range moves on the daily chart. And there's a lot of volatility. As an index trader, you want to know when there are earnings seasons. And you also want to be aware that during the summer months, now this hasn't really been true in the last 2 months. the last 2 years rather. Typically the summer months, and when I say that, it's like July, some of June's good, but July and August, they can tend to be really just real cruddy type of market conditions where you don't really want to be pushing it too hard. And it's better really to just take those months off. And that doesn't mean you can't find trades, and obviously you've seen I can do that too. But when I teach, okay, the detractors out there love to try to take one thing that I say and twist it up and try to make an argument out of it. They'll say, ICT says that he doesn't trade on Mondays, and here's my example of trading Mondays. Okay, I go out and trade Mondays. I'm just telling you what I like personally. Now, you can go out there and trade, every single day of the week. I've given you tools and rules to follow doing that. But I like to have a lot of things in my favor before I go out there and just try to engage, because my character flaw and my weakness is I want and aim for perfection. And you see in my entries, I'm in there on those high candles going short, and I'm getting out on those low candles when I'm covering the short, and I'm buying on the low candles and I'm selling at the high candles. You can't deny that. And it's matching everything that I teach. The logic is there. So if the shit didn't work, I couldn't produce that in live market conditions, period. Gotta wet my whistle here. So understanding when there's the likelihood of having big moves, like for instance in spring, there's a tendency for the market to draft lower in equities. Okay, so stock indexes, or indices rather, they have a tendency to draw lower and be bearish going into the summer lows, and then going into a low in the fall time, somewhere between. I've seen it in years of my career where it starts a move in August, the last week of August, but generally it's like between mid-September and the first or second week of November, you're going to find a seasonal low there. And all you got to do is look for what I taught you in the core content. If you simply just use that model, look for index divergence, SMT divergence between the NASDAQ, this S&P, and the Dow. I don't trade the Dow. Okay, I don't care about the Dow for trading purposes, but I use it for an analysis, like dollar. I don't trade the dollar, but I've always used it as a barometer for forex pairs. So it's going to be a diametrically opposed opinion held in dollar versus other currencies. Well, when you're comparing the three averages, S&P, NASDAQ, and Dow, and you're looking for a high to form in the spring, you want to see a divergence. One of those indices is going to fail to make a higher high. That's it. You have now witnessed the quarterly shift. Now, everything after that, start looking for market structure shifts bearishly on all time frames, and look for the pattern that I taught you in the 2022 mentorship. And folks, I just fucking gave you an ATM that pays out every motherfucking year, and it gives you the bias going all the way into the summer. That's it. That's the key. That's the fucking unicorn you're looking for. Well, how about in the fall? You're looking for the opposite, because seasonal tendency wise, you're looking for a low to form. So one of those indices are going to fail and make a lower low. Once that occurs, what happens? That failed lower low in one of those averages, that's simple Dow theory. Once that shift occurs and they go breaking their short-term highs, you're now in a buy model. What does that mean? You're just looking for longs, and you keep milking the longs with the largest leverage. And you can take shorts, and you've seen me do that. But the bigger moves, the longer protracted candles on the daily and 4-hour charts are going to be to the upside after that occurs in the lows in the fall. So between, like I said, think like the second week of September to the second week of November. That's your little sweet spot. And what you're looking is you're studying, kind of, you're like, can you back and tell me what you just said there again? I ain't looking at questions, but I'm sure it's probably what you're thinking. What does it look like? Where am I looking? What time frame? You're looking at a daily chart. You're looking for the highs compared between the NASDAQ, the S&P, and the Dow. Make sure I said that right. Those three averages, Dow, S&P, and NASDAQ. In the springtime, okay, April, May time period. In that time period, you're going to be looking for, as the market's going to be going up, it will be. It'll go up, and on a daily chart, one of those averages, and I don't give a flying fuck which one it is. I don't care which one it is. It's not a point of me knowing which one's going to fail to make a higher high. I'm just looking for that to occur. Once that happens, once that occurs, and then you start looking at the 1 hour and 4 hour chart to look for a shift in market structure, just like I taught in that 2022 mentorship. Once that occurs, you have watched the seasonal high form in the spring, and it's all downhill going into the summer months. Baby, if you don't know what that means, let me tell you something. Go back to your fucking charts. As many years as you fucking want, and just see how that is such a beautiful roller coaster into fucking profitability every motherfucking year. And you got clowns out there doing mentorships and signal services, and they're trying to buy all during that shit. And they're getting wrecked. They're getting destroyed, blowing out, and having to reset their simulator accounts. That's how the markets work, folks. And in the fall, on a daily chart, you're comparing the NASDAQ, the Dow, and the S&P. One of those averages are going to fail to make a lower low. All you're doing is simply waiting for that. You're simply waiting for that to occur. And once it does, go into your 4 hour chart or 1 hour chart and start looking for that shift in market structure bullishly. Once that occurs, you just watch the low form in the fall and just start looking for your best trades going long. You can, if you have not been trading at least for 2 years consistently, don't fade what I just gave you. Trade only in those directions. And you're going to get the biggest fucking moves you've ever had in your trades. And you'll be able to trust that they're going to move a lot more than just 5 trade Larry in fucking Texas that wants to get 5 ticks and thinks it's a big deal because he's got 24 contracts on it. No. You want big fucking runs, big price runs. And I have students that are going in the Robbins Cup. I just gave you a beautiful blueprint to work within. Think about that. These are market dynamics that, I'll have people come in. Oh, everybody knows that. Okay, show me your fucking trades. Show me your executions going into next year. Do it. Because I'm going to be doing it. Oh, yeah, I'm going to be fucking doing it. Live accounts. Oh, yes. I'm going to be breaking fucking hearts. Motherfuckers are going to have their heads fucking smashed. Yep, your results are shit. I'm going to prove it. So we've talked about market structure. And the only importance really is knowing what I just gave you. That right there, that element of seasonality and how those shifts quarterly occur, one in the springtime for bearishness and in the fall when it's bullish. And what does it look like? The S&P divergence or Dow divergence, okay, where one of the averages diverge. And then you're looking at that shift in the market structure on a 4 hour and 1 hour chart. Once that fucking occurs, that is it. It's on lock. It's done. Then it's going to start grinding higher. You don't think it happened? Look at your chart. Why do you think I've been buying? Well, I've been talking about it's reaching for relative equal highs. It's going up to an imbalance. This is SIBI. It's filling. That's why. That's why it's following that model. Those videos I produced in 2016. Well, no, technically that would have been 2017. Yeah, because it's closer to the August end of 2017 when the first mentorship group ended, and that core content was produced during their class. So yeah, it would have been, if I'm not mistaken, I think it's June